So I appreciate you being here today. As I look at this picture of a boy looking at a paper, I'm reminded of when I was newlywed to my wife, Karen. We would take day trips and travel around exploring new parts of Connecticut and new parts of the country. And back then, which hard to believe, it was 30 years ago this year, we did not have cell phones or GPS. We depended on paper maps and atlases like we have here. So it caused us to kind of explore, and we didn't know what to expect. And we still joke with the fact that many times it would not be what we call a true adventure unless we randomly found a dirt road to travel by. And as we look ahead to 2023, we can have some of those familiar emotions of not knowing what is ahead or what to expect. So that is what we're here to talk about today. Hello and welcome, everyone. My name is Greg Hammond, CEO of Hammond Iles Wealth Advisors, and I'd like to welcome you to our monthly Education Financial Power Hour. We're here to share information with you on how to navigate 2023, looking at investment strategies in an uncertain year, and as an added bonus, we're going to share some information about some of the retirement changes that are going into effect immediately or in the coming years related to the Secure Act 2.0. So let's talk a little bit about navigating 2023. To just start out again, I'm sharing a little bit of the formalities of our financial industry. As you commonly hear, past performance is no indication of future results. And what I'm sharing with you today is my outlook and my opinion, and not necessarily anything to base a lot of investment decisions on, because no one can predict the future. And if there's anyone out there that is telling you that they can predict the future, well, I would run the other direction. Now, as I mentioned throughout today's presentation, questions are welcome. I encourage you to type those into the Q&A function as part of this webinar. And again, I apologize for the challenge with the chat feature, but we'll make sure that we get your questions answered one way or another. Also, if you think of questions afterwards, or we don't get to a question that you have, you can always go to our website at hiwealth.com and click on a button to schedule a 15-minute conversation, or you can send your questions to hello@hiwealth.com, and we'll make sure that we get those addressed for you. So what is kind of our agenda for today? We're going to talk about how stocks performed in 2022, what impacted market performance in 2022, where we are now and what is the outlook for 2023, some investment strategies to handle that uncertainty that we're facing this year. And as an added bonus, it's not Ginzu knives, but it's a bonus. We're going to talk about the changes that are coming or have come this month with the Secure Act 2.0. So how have stocks performed in 2022? Well, let's take a quick look at kind of where we ended the year as measured by the Standard & Poor's 500 index, which is an index of the 500 largest U.S. companies. An index, by the way, is not something that you can actually invest in. So the index funds try to follow the index as close as possible, but there will be some differential there. So when you typically see the index mentioned, it is an unmanaged index that is a representation of a part of the market. For the Standard & Poor's 500 index, we ended 2022 at 3,839.50, which for the calendar year is a decrease in value of 19.44%. Now, if we jump in our time machine and go back and take a look at how did some of the large financial firms kind of measure their or estimate on where the S&P would be at the end of the year, what we find is that they were off base and by quite a bit. The average was around 4,867. So they anticipated that the markets would actually go up slightly. Just so you know, we ended the year at 4,766. That is at the end of 2021. So we went from 4,766 down to 3,839. So some did anticipate that it would be kind of a flat or slightly down year, but most expected the year to be better than what it turned out. Now, when we take a look at, well, what impacted that? How did things evolve in 22 after making those predictions? Well, here is just a list of 9 events that I think had a significant impact. One is that we continued to see supply chain issues. I'm not sure about you, but now when I go into the store, I'm seeing more frequently empty shelves here and there. So it's still a challenge that we're facing even into 2023. And certainly one of the events that no one predicted was Russia's invasion of Ukraine, and that conflict that continues through today continues to impact world economies and the financial markets. We saw inflation in 2022 pick up after the pandemic, and as we all started to come out and started spending again, the question was, was it just temporary because of that built up demand, or would it last longer? What we're finding now is it is lasting longer, but it peaked out at 9.1% during the year. And to help hedge against that or address that inflation, the Federal Reserve raised their interest rates by 4.25%. That's a huge increase. When we started the year with their target rate between 0 to 0.25% to now being at 4.25% to 4.5% as the target, that is a 425% increase of interest rates in just one calendar year, which is substantial and had a dire impact on the bond market. And I'll talk a little bit about that as we go through our presentation. And because of those rapid increases, where we normally see the bond market as being the stable part of our portfolio, we actually saw the volatility that both stocks that were down and bonds lost value this year. So it was a unique situation where that happened in the same year and created more of a downturn on portfolios than many expected. Now, hopefully you don't have any money invested in cryptocurrencies, but we have seen that whole speculation of cryptocurrencies in new type of speculative investment collapse. We've seen companies file for bankruptcy, and that whole unregulated side of the currency market or investment market, it shows why sometimes regulations are prudent. And then that political red wave that we were anticipating in November turned out to be a red ripple. That there was just a little bit of change. Certainly the House of Representatives changed over from being a majority Democratic to Republican, but otherwise the Senate remained the same. Now, also, we are starting to see some impact, the fact that China is ending its COVID-0 policy, and there's still some speculation on what that will look like for the coming year. And then we reached the lowest unemployment rate in over 50 years. The current rate of 3.5% hasn't been that low since I turned 1 year old. So I'm a little over 50, by the way, but it's been a long time since we've seen unemployment reach that level. So when we take a look at the year, how does that look for us? And what we see is that what we have is an up and down market. And that one of the things to take away from our presentation today is that when we have uncertainty in the markets, it causes the markets to trade more based on daily headlines. So what we'll see in the news tends to influence the trading of that day. And so when certain events happen throughout the year, it has more impact of immediate ups and downs impacting that. Whether it's the publishing of the gross domestic product or the GDP, the measurement of the US economy, whether it's the Federal Reserve raising interest rates again, or some other economic or geopolitical event that causes concerns. So we ended that year, as I mentioned, down 19% for the year. So when we take a look at what that looked like over the year, what we see is that the US economy actually went through a recession in 2022, both in the first quarter and second quarter of 2022. We had negative GDP growth, negative 1.6% for the first quarter and negative 0.6% for the second quarter. And since then, the economy has picked up steam a little bit, being back more towards a more normal growth rate. We actually have the fourth quarter now at 2.9% for the calendar quarter. Now, what we do see, though, looking at these numbers is although inflation did peak at 9.1% in the second quarter and in June, actually, we have seen inflation start to come down. That labor market has continued its strength, maintaining unemployment rates right around that 3.5%. Consumer sentiment, though, has started to wane a little bit in the fourth quarter. One of the reasons why we most likely did not see kind of a large Santa rally at the end of the calendar year. And as the housing market goes, that inflated pricing of 2021 and 2022 is starting to soften as those higher interest rates ripple through the mortgage market. So we've talked about where we've been. Now I want to take some time to talk about where we are now, and then what does it look like for 2023 going forward. And again, this is an outlook or just an anticipation of what I'm seeing in the markets, and the factors that may impact it is not necessarily a prediction with my crystal ball, which tends to be a little hazy. So what does it look like for the coming year? Well, right now, what we're seeing when we're looking at the leading economic indicators, and this is an index made up of 10 different indicators, everything from prices to manufacturing. And what we're seeing is that that indicator is trending lower. It has dropped below zero, so that has historically pointed towards a recession. But as we looked at in the 2020, that recession was very short and very shallow. And so the question becomes, if we do have a recession for 2023, will it be a substantial recession for an extended period of time? Will it be very short like we experienced in 2022? Or some are talking about the fact that we may not even experience a recession. So I'll point to some of the reasons why that might be the case as I share some additional information with you. So again, taking a look at Wall Street and the large financial firms, once again, putting out numbers, trying to predict the future. They are averaging ending of the year around 3,800 points, which again, we started this year at 3,839. So most large Wall Street firms are predicting kind of a flat year, that we may have some ups and downs. But as we saw in their predictions for last year, circumstances change and usually they're not correct. So we'll see, are we going to be higher than that or lower? Because most likely we're not going to hit their predictions. So what are some of the things as we look ahead to 2023 that are some of the headwinds? What are the things that we have to kind of overcome to have a positive year? Well, although inflation has come down a couple of percent, it's not down to the level of 2% where the Federal Reserve would like to see inflation. So we're continuing to see that inflation linger, and whether or not that will take time or whether the act of raising interest rates will start to take effect and we'll see that inflation rate come down as a result of it. It's a difficult balancing act, one that I would not want to be in charge of. And it is hard to say because you put something in motion that you typically don't see the results of for 6 to 12 months down the road. So have they raised interest rates too far? Some would say yes. Some would say not enough. They'll be talking about that again today, where they'll actually be talking about the next potential interest rate hike, which I believe will be less than what we've seen as the interest rate hikes in 2022. So that federal policy is uncertain. And because of that, we're not certain whether there will be a recession. One of the other items that is a definite headwind is the national debt limit. That will definitely be in the news more often in the coming weeks as the Treasury juggles their balance sheet to be able to pay the bills of the U.S. government until Congress authorizes an increase in that debt limit, which the hard deadline will be in June of 2023. So they will most likely come up with some solution before then. But just having that uncertainty, as I mentioned, will weigh on the financial markets. Then corporate earnings. We have, as the consumer spending decreases, as that consumer sentiment, and because of higher prices of housing or other items, we may scale back in our spending, and so corporate earnings may suffer. However, as I'll get into our tailwinds, that may also be counteracted by some other things that we're looking at. There's also geopolitical tensions. Obviously, the conflict in Ukraine and Russia is something to be concerned about. Hopefully that will be resolved at some point, hopefully in the near future. There's also geopolitical concerns of China over Taiwan, or what will North Korea do this year. There's a lot of things that could happen, or a new place in the world that we may not even be talking about today. We're also facing, because of the rapid rise in interest rates, we're facing what's called an inverted yield curve. Normally, when you look at a yield curve, what that means is that if you were to purchase a bond, say a 10-year bond, it would have a higher interest rate than a 2-year or a 5-year bond, similar to interest rates that you see advertised for certificates of deposit at a bank. The longer you commit to a bond or a CD, the higher you would anticipate the interest rate to be. But that is not the case currently. We're inverted, where actually shorter durations or shorter term bonds and certificates of deposit are paying higher interest rates than if you were to try to lock in a rate for a longer period of time. Typically, that's historically a sign or a potential sign of a recession. But we'll see if that corrects itself or leads us into a recession. Now, as I mentioned, it's not all bad news. There are some good things to point to, what we call tailwinds that will help to push the economy and the financial markets through 2023. As I mentioned, inflation is moderating. It is coming down. It's certainly not at a level that the Federal Reserve would like, but it is coming down. And because of that, we have what we call a more dovish Fed, meaning that they're taking their foot off the gas a little bit, that the interest rate hikes that we'll probably see in the near future will be smaller and slower in between them. One of the other tailwinds that we're seeing is that the US dollar is actually falling in value, which has a benefit for global companies doing business around the world. They'll have the opportunity to be able to sell more abroad, and the US goods will be cheaper to those buying internationally. And as I mentioned, we continue to have a strong employment market. Our unemployment rate's at 3.5%. Right now, they're estimating around 5.7 million people unemployed, with close to 10 million job openings out there. So there are plenty of opportunities for employment, although it's a matter of lining up the right skill set with the right position. We are looking at this interest rate cycle as a positive because when we take a look at kind of expectations of interest rates in the future, many are seeing the peak in the near future. That at some point in 2023, we will most likely reach the top of where interest rates peak out, and that the Federal Reserve may at some point start to reduce interest rates at that point. One of the other things I like to point out that I think is commonly forgotten about is fiscal stimulus. During the pandemic and shortly, well, we're still in the pandemic, but over the last few years, we've had a huge amount of government spending, one of which is the infrastructure bill, $1 trillion on infrastructure. And many of those projects are just getting going. So a lot of that spending that was part of those stimulus bills is still working its way through the U.S. economy. So that is going to be a positive for the economy to continue to see that economic activity, because as those infrastructure workers, whether it's repairing a bridge or roads or that dire infrastructure that's falling apart that needs replacement, those people, as they get paid, that money will trickle through the economy. They'll turn around and spend it. And so we'll continue to see some tailwind from that that fiscal stimulus that was passed over the last few years. And as I mentioned earlier, China is reopening. So that opens up a lot of economic activity, being the second largest economy in the world. It creates a lot of demand for goods by the people of China, as well as certainly making some of those supply chain issues dissipate as they're able to produce more. So when we're taking a look at the going forward, the Philadelphia Federal Reserve in their predictions, and this is looking in November of last year, looking ahead to the fourth quarter and the 4 quarters of 2023, they did reduce their projections for the gross domestic product as to how the U.S. economy would grow, and that unemployment would gradually increase. But I find it very interesting that they reduced it down to 1% for the fourth quarter of 2022, and we actually ended up at 2.9%. So it is interesting that even their predictions underestimated the strength of the U.S. economy. Also, the other thing I wanted to point out about this chart is that you'll see that even with a slowdown of the economy, for the first and second quarters, you don't see their prediction going negative. So as far as the Federal Reserve is predicting through this real GDP, they're not predicting a recession. They are predicting a slower economy, but not to the point of having negative GDP. Now, one of the other ways of kind of taking a look at where we are in the stock market is what we call the PE ratio, or price to earnings ratio, which takes a look at what are we willing to pay for stocks on the market. And this is looking at those 500 large companies in the S&P 500 index. So as of September 30th, we were actually at 15 times earnings, which historically over the last 25 years, we've averaged closer to around 17 times earnings. So we were below that. Now, at this point, with the rally that we have seen so far here in January of 2023, that PE ratio has come back up. It's now right around 20. So it's getting up towards the higher side. But the interesting thing is that this is looking at large U.S. companies. If we were to take a look at the same chart for the Russell 2000 or small size companies, you would actually see a different picture, that small size companies right now are undervalued. So there's some opportunity there. If you own small size companies, if you don't know if you own small size companies in your portfolio, I encourage you to reach out for a complimentary conversation with a financial coach at Hammond Iles. We'll be happy to run a portfolio MRI that will analyze your portfolio so that you have a complete understanding of what you're invested in, because we do believe that the best client of ours is someone who knows what they're invested in and why. So again, taking a look at interest rates on where we are, we find that the outlook for interest rates looking ahead to June of 2023, that there's a 50% chance that it'll be somewhere close to where it is now or within 0.5% of where we are. So it's still 50-50 that we'll have a relatively slowing of the rises in interest rates by the Federal Reserve. And I think that we continue to see that will probably shift down as we get more information on rates. The other thing in taking a look at recession, and this is one of the reasons why I think it's extremely difficult to try to project whether we're going into a recession, is typically unemployment going up and job layoffs go hand in hand with a recession. And although we have seen in the news some job cuts from technology companies, largely due to the fact that they really ramped up and overhired during the pandemic and are right sizing now, we're not seeing job layoffs across the board. And I believe that that is due to the fact that it's a tight job market. And the last thing you want to do is lay someone off and then have to try to find somebody, especially for a lot of companies that are looking to hire people and having a hard time filling the current positions that they already have open. So that's kind of our outlook. So it's uncertain. There are headwinds that we're going to be pushing against, and there's some tailwinds that are pushing that may encourage the markets to continue to grow. So what is it then? How do we plan our investments? What strategies do we use in an uncertain year? And you'll see that I don't put 2023 on here because guess what? Every year is an uncertain year, because the financial markets will move only because of new information. And so there's a couple of things that I want to highlight here before I go into kind of these investment strategies. The first is that nobody can predict the future, and that the financial markets already include in their pricing all of the known information that's out there. So the thought that there is going to be a recession this year, investors have already priced that into the stock market. It most likely was some of the downturn that we saw in December or back in September that was already priced into the markets. So the only thing that's going to move the markets going forward is new news or new unpredictable events. So how do we address that? Well, we believe that there are 3 investment rules when it comes to investing. The first is that you should own equities. And that doesn't mean that you should be entirely in the stock market. But what it means is that you should have part of your portfolio invested in the stock market, because the best way to hedge against inflation is the stock market, which historically has always been up over time. Now, some signs of that and ways that we can look at this is this chart looks at a portfolio that's 60% stock and 40% bonds, as represented by the S&P 500 index and the Bloomberg Aggregate Bond Index. And what you'll see here, going back to 1977, that 2022 was the first year where both the bond index and the stock index were down in the same year. All of the years past that, bonds have held up when the stocks were down. So that bond portion is there for stability and to provide some safety in your portfolio. So the question then becomes, what level of risk are you comfortable with? It may be a 60-40 portfolio. It may be more conservative than that. It may be more growth oriented than that. And that's part of working with a financial coach, is having that conversation to really look at a worst case scenario to determine what level of risk that you're comfortable with. But over time, you'll benefit from having a part of your portfolio invested in equity. Now, another chart that I wanted to show you about this, again, looking at a 60-40 portfolio, is how that portfolio has reacted to different crises that we've seen over the years. In particular, I want to point to the one that's on the far right. In August of 2011 was the last time that Congress flirted with the possibility of defaulting on U.S. debt. We got right up to the debt limit in the same scenario that we're here now. They ultimately did pass an increase to the debt limit and we moved on, but the financial markets had gone down leading up to that, about 16% in a few weeks leading up to that. And it actually, because of that uncertainty, led for the first time in our history that the U.S. national debt was downgraded in its credit rating. However, when we take a look at this chart, how did that portfolio do after that incident? Well, within 1 year, it was up 7%. Within 3 years, it was up 36%. And in the 5 years following that, it was up 42%. So I hope that this chart gives you some confidence that although there may be a short-term pullback due to whether it's the debt ceiling or some other crisis that comes up, that within a short period of time, the markets rally. And in most cases, it's within a year, and it's definitely within 3 years that we see positive returns. So that's our first investment rule, own equity. So part of your portfolio should be in stock, and that can be both large and small size, which kind of leads into our second rule, which is that you should be diversified globally. So not only should you own small and large size stocks in your portfolio, but you should also own international and US stocks. So if we take a look at just a recent report in the Wall Street Journal, it's kind of too late if you don't have international in, but international over the last 3 months has outperformed the US. In that in the last 3 months, international stock index was up 21% versus the US being up 8.5%. And what we see when we take a look at a chart as to how that goes back and forth, as you can see, it varies from US, which is the lower part of this chart, and the international outperforming US on the upper side of the chart. It's a constant ballet between back and forth. And so it's important to be invested internationally. You know, one of the other things that I find interesting is every year, the Wall Street Journal at the end of the year posts a chart listing all of the countries in the world and how their stock market performed over the last calendar year. So it's interesting that in 2022, Turkey was up 105%. Now, did you hear anybody last year talking about the fact that you should be investing in Turkey? And I'm not talking about for Thanksgiving. It's the country of Turkey. Did you think to invest in the country of Turkey? And there are actually multiple countries that had double-digit returns, whether that is Chile or Oman or Jordan or Bahrain. All those countries had positive returns despite the US being negative. And actually, there's 44 countries on that list that outperform the United States. So when it comes to your portfolio, are you invested globally? After all, when we look at all publicly traded stocks in the world, 52% is in the US and the other 48% is international. So if you're not invested internationally, you're missing out on half of the stock market around the world. So definitely something to look at. And again, if you're not certain whether you're invested internationally or how much you have invested internationally, contact our office either by going to our website at hiwealth.com or giving us a call, and we'll have a conversation to look at your portfolio. Now, the third rule is then once you have that globally diversified portfolio, you have determined the amount of risk that you want to have in a portfolio, it's important to rebalance. And we just had a webinar meeting like this about rebalancing. So if you want to learn a little bit more about the benefits of rebalancing, I encourage you to view that. You can also contact our office and get one of these lovely Keep Calm and Rebalance shirts, because when you have a portfolio, if you just allow it to run over time, because the stocks will outperform bonds over time, you'll end up taking more and more risk. So it's important that as the market goes up, we trim back the stocks, buy more bonds to maintain the level of risk that you want to have. And vice versa, in a year like last year where the market went down, actually selling some bonds and buying more stock while the market is low. By having a systematic process of rebalancing, you follow the golden rule of buying low and selling high. So I encourage you to implement those 3 investment rules as a great way of addressing an uncertain year. Now, what are some steps for you to take? Well, one is, if you're a client of Hammond Iles, keep us informed of any important life changes that may impact your risk return preference related to your portfolio. So it may be time to have a conversation about your investments if something has changed in your life. Also, tell us about your concerns. It's one of the reasons why we host these education workshops. We want to keep you informed as well as provide an opportunity for you to share your concerns, whether you share them with us through the Q&A during our event itself. Email us afterwards at hello@hiwealth.com, or just reach out to us to have a conversation. And as a reminder, I encourage you to make sure that your essential documents are up to date. Are your beneficiaries who you want them to be? Do you have legal documents in place, and are they up to date? We have a personal financial portal, which is where you can log in and see all of your accounts that you have invested with Hammond Iles. But it also has a vault feature where you can store those documents. So if you need some assistance on scanning and uploading those documents into our personal financial portal, please contact our office and we'll be happy to help you out with that. So lastly, what are we going to do at Hammond Iles? Well, we're going to keep you informed through regular communication. So I encourage you to follow us on social media, to go to our website and make sure that you register for events like this, as we have them on a monthly basis going forward. Also, we will take a stand for you as your financial coach, because to have successful investments, it's not just creating the best globally diversified portfolio based on science. And yes, there is science to investing. There are other workshops I encourage you to look at, like Dispelling the Myths of Investing, if you'd like to learn more about that. But that's just part of the equation. We are all human. We have emotions, instincts, and perceptions about how things are. And those buttons tend to be pushed by media and the information that we take in. And so part of our role as a financial coach is not only to guide you to having an academically based portfolio, but also to be by your side through these challenging and uncertain times. So when you do have those emotions, we can keep you calm and rebalance through them. And as I mentioned, we'll continue our rebalancing process. We review all of our accounts every 90 days and potentially rebalance them. And we'll rebalance them at least once a year to make sure that we're maintaining the level of risk for you. So that's where we are, what our outlook is on 2023, and what it might be the best way to address that uncertainty through your investment strategies. Again, if you have any questions, please add them to the Q&A, and I'll be happy to answer those for you. And certainly, I'll be checking those at the end as well, because this is not it. Yes, there's more. And it's not Ginzu knives. It's not an extra stay at a hotel. No, today you get the benefit of learning a little bit more about the Setting Every Community Up for Retirement Enhancement Act, SECURE, as it's known, 2.0. The original act was passed in 2019, and there are some big impacts of that first passing of the SECURE Act. I'll be talking a little bit about that at our next workshop in March. of 2023, which will be talking about 2023 tax strategies. So keep an eye out to register for that event. We'll talk a little bit about how the stretch IRA has gone away and how that will impact you and your family. But today I want to talk a little bit about some of the changes that have come into effect that may impact you when it comes to planning for retirement. So there's a whole host of changes. They threw everything into this bill. Some are just minor changes and some are significant. So the first batch I want to talk about are distribution rules, and particularly related to required minimum distributions. So this is when Uncle Sam gets tired of you waiting to take money out of your retirement accounts and pay tax on it. So they require you to start at a required beginning age. At the present time in 2023, that now has been increased to 73. So if you're turning 72 this year, which was the old beginning age, guess what? You get an extra year. So you get to wait until next year when you turn 73. And then ultimately in 2033, it'll go from 73 up to 75. So one of the ways to think about that is just through your birth date. So if you're born before 1951, your beginning age is 72. If you're between 1951 and 1959, your beginning age will be age 73. And for those of you that are born after 1960, you'll have up until age 75 before you'll be required to take amounts out. Now, even though that required minimum age has increased, it's kind of an interesting thing that for both 2023 and 2033, nobody new will take distributions that year because of it. Those are the two transition years. But if you did reach age 72 before the end of 2022, you will have to continue taking minimum distributions just as you have. Although in 2022, they did adjust the required minimum distribution calculation table. So that may impact your distributions, but you will be required to continue to take those. Also, if you, as I mentioned, turn 72 this year, you get a pass and you get to wait until next year. Also, one of the interesting things that they did around required minimum distributions is related to the Roth accounts as part of employer retirement accounts. That's 401ks, 403bs. It used to be that even those accounts would require a minimum distribution if you were of age. And it was one of the primary reasons why we would encourage people to roll over their Roth out of their 401k or 403b into a Roth IRA, because in a Roth IRA, there are no minimum distributions since that money comes out tax-free. Well, they finally corrected that, and now it's the same. So starting next year, there's no minimum distributions from the Roth account in a retirement account as well. Also, just as one of the things that has not changed is related to qualified charitable distributions. The beginning age of when you're eligible to make those is still at 70 and a half. So you still have something to worry about on your half birthday at age 70 and a half. And actually, it's not something to worry about. It's a great thing, and I'll talk a little bit about that in just a minute. So one of the other things related to required minimum distributions is that the penalty has been reduced. So before Secure Act 2.0, the penalty of missing your minimum distribution was 50%. And that's a 50% penalty on top of the income tax that you would have paid when you pull that money out. Now, effective this year, that penalty has been reduced to 25%. And they added a little asterisk there that the penalty could be reduced even further to 10% if it's corrected in a timely manner, which by the tax code is generally within 2 years. But that's going to be one of the things that will be coming out with further regulations from the Internal Revenue Service as they kind of work through the passing of this act. Since it was just passed on December 29th of 2022, it didn't really give anybody a lot of time to make some adjustments. And as always, you can always apply for a waiver of the entire penalty if you feel that there were circumstances that led to it being delayed. Now, there are some changes to the qualified charitable distributions, or what we call QCD. And if you're not familiar with qualified charitable distributions, what a qualified charitable distribution is that you are allowed to distribute or pay out up to $100,000 a year from an IRA retirement account to a 501c3 charity. And when that money comes out of your IRA, it comes out, you don't pay tax on it, and the charity doesn't pay tax on it, but yet it counts towards your minimum distribution. Now, this does become eligible at age 70 and a half. So there's a window there that you could make qualified charitable distributions before you have to start taking required minimum distributions. But eventually, when you are required to take out minimum distributions, this will count towards it. So it's a great way to use pre-tax dollars in your IRA for charitable purposes. Now, one of the keys here is that this only applies to IRA accounts. So if you have money in an old 401k or a profit sharing plan, that money will have to be rolled over to an IRA before you can pay it to charity. Now, some of the changes that happened is that effective in 2023, you can now make a one-time donation of up to $50,000 to what's called a split interest entity. And what that means is that there are two kind of beneficiaries of those accounts. So for example, a charitable remainder trust or a charitable gift annuity, both of those can be set up to pay you an income during your lifetime, and then the remainder of the account passes on to the charity when you pass away. So it can be a great way to add some additional retirement income while making a charitable impact. Now, one of the other things, as I mentioned, is that the limit on an annual basis is at $100,000 per year. And starting next year in 2024, that annual limit will increase for inflation. Now, in addition, part of the distribution rules that got updated is that there were some changes to the 10% early withdrawal penalty. There's now an opportunity that if you have a financial emergency, that you can take up to $1,000 in a calendar year and you can repay it back to your IRA retirement account, and that goes into effect next year in 2024. Also for public safety workers, they have a special provision that if they take money out of a retirement account after age 50, they're not subject to the 10% early withdrawal penalty. The definition of public safety workers has been expanded to include public firefighters, correctional officers, as well as individuals that have worked for a town or municipality or public safety agency for more than 25 years. And that is effective this year. Also, they added an exception to the early withdrawal penalty for natural disasters. So if you're under the age of 59 and a half, you can tap into a retirement account of up to $22,000 to repair your home or deal with a natural disaster. And you can repay that, or you can spread out the taxation of it over a 3-year time frame. One of the interesting things is they made this retroactive back to 2021. So if you happen to live in an area that was affected by a natural disaster over the last couple of years, you have the ability, you could go back and actually amend your tax return. Also, there are distributions now for terminal illness that can be tapped into. That's effective this year. There's also opportunities for those that are victims of domestic abuse to tap into a retirement account without an early withdrawal penalty. There's also going to be the opportunity to tap into your retirement accounts for long-term care, although that doesn't go into effect for 3 years or in 2026. And they've also eliminated any penalty on the earnings of excess contributions. So if you put into a retirement account and then you find out because of a bonus or an increase in your income that you made too much and you weren't eligible, and you take that contribution back out, you also have to take the earnings out. There's no penalty on the earnings. Now, keep in mind that these distributions coming out of retirement accounts, this is just an exception to the 10% early withdrawal penalty. Those amounts are still subject to income taxes. Now, there's also better ways to contribute. One of the things that the Secure Act 2.0 wanted to address is encouraging people to save more for retirement. So they put some new contributions in place. So they increased the catch-up contribution provisions. So beginning in 2024, the $1,000 catch-up contribution for those over the age of 50 for an IRA will increase for inflation and be adjusted upward. Also, they've created this kind of catch-up catch-up contribution booster is more of the way it is for between the ages of 60 and 63. So as you're approaching that finish line and you need to get just a little bit more into your employer retirement account, there's now going to be a higher catch-up contribution of between the ages of 60 and 63 that go into effect in 2025. And basically what that is right now the catch-up contribution is $10,000, for example. So starting in 2025, that catch-up contribution will equal 150% of what it is in 2024. So you get that extra 50% of the catch-up contribution for those in that window between 60 and 63. Same holds true for simple IRAs with the catch-up contribution as well, be 150%, although it's going to be based on the 2025 value. Also, for new 401ks and 403bs, I think this is a great thing. They've added automatic enrollment. So if you are new to the workforce or you have children or grandchildren that are coming out of college, if they have an employer that is just starting up a new 401k or 403b, beginning in 2025, all employees will be required to be automatically enrolled in the plan to save at least 3% of their income. However, employees can opt out, but as we see kind of the law of inertia, that if we automatically enroll people, most people will just let it roll. One of the interesting things is that they'll then require an annual contribution rate to be increased by 1% each year until it reaches at least 10%, and employers could have it go all the way up to 15% of income. Now, this only applies to new plans. So if you're currently working for an employer and participating in a 401k, this automatic enrollment doesn't apply to you. It also does not apply to simple IRAs, to churches or government plans, or employers who have existed less than 3 years. So if it's a brand new company just getting started up, they're not going to require this automatic enrollment. Now, they've also expanded Roth contribution levels. So for the coming years, they've added simple and SEP Roth IRAs. So if you have a simple IRA plan, it will now, as soon as the custodians find out how to kind of re-update or renew and update their documents for your plan, they'll be adding a Roth side of it, and same with simple IRAs. One of the interesting things also with 401ks is your employer match has always gone into the kind of the traditional side of a 401k that is on a pre-tax basis. Well, going forward, you'll now be able to elect to have that employer match go into the Roth side of your 401k. That is, if there is no vesting schedule. Now, keep in mind, though, that money, just like when you contribute to a Roth side of a 401k, you pay tax on it before it goes in. So that employer match before it goes into the Roth side will be taxable to you in the year that that match is paid to you. And then starting in 2024, individuals with over $145,000 in the prior year, now their company match must go into the Roth 401k. So if you make over 145,000 and you get a match from your employer, starting next year, they're going to have to put that into the Roth side, and that basically triggers more taxable income for you. So it's an interesting way of adding more income to those that are earning a higher level of income. Now, one of the new things that can be rolled out by employers are these new emergency savings accounts. Again, Congress is trying to encourage individuals to save, and in this case, for emergencies. And so employers have the ability, starting next year, to offer an emergency savings account. It's basically tied to the employer retirement account. So it's tied in with like the 401k at your employer. And employees will be able to auto-enrolled again to contribute up to 3% of their compensation into the emergency savings account. Now, employers must match those contributions just the same as if they were going into the retirement plan. That's why they're kind of tied together. And the employer match goes into the retirement plan. So the employee is contributing up to 3% of their salary into this emergency savings account. If the company matches contributions to retirement plans, they're going to match that, but it won't go into the emergency savings account. It'll go into the 401k. So I'm sorry if you're an administrator to a 401k or you work on HR, a little bit more bookkeeping coming your way. And this emergency savings account, it's not unlimited. It's not intended to exceed $2,500. So that's going to be the max that's there. And so, and it will be required to be maintained in a cash equivalent investment, kind of like a savings account. So it's really intended as an emergency savings vehicle. So those contributions are added in after taxes, and then just like a Roth, the emergency savings come out. So the interest that is earned on those cash equivalent investments will eventually come out tax-free. So you can tap into that as needed. Lastly, as I'm starting to wrap up, there are some student-related changes. Again, trying to encourage people to save more. Beginning in 2024, employers can make matching payments to a retirement plan equal to payments on student loans. So an employer, as an incentive of hiring somebody with student loans, saying, hey, take care of your student loans, make sure you make those payments. What you pay on those student loans, if you provide me documentation that you made payments, I'm going to match that just as if you contributed to the 401k. So it's a way, again, for employers to provide a benefit to employees that are dealing with student debt. Now, also, one of the interesting things related to students is 529 plans. These are the savings plans for higher education. Now, if there's money left over in those plans, you can actually roll it over into that person's Roth IRA. It is a maximum of $35,000, and the 529 plan must have existed for 15 years, and contributions into that account in the last 5 years don't qualify. So you can't open it up and stick a bunch of money into the 529 and then immediately roll it over. Also, the amount that you roll over is limited to the Roth IRA contribution amount. So for 2023, that maximum amount is $6,500. So that maximum amount that would be eligible to be rolled over. So if you have $10,000 left over in a 529 plan, it'll have to be rolled over in 2 installments over 2 years rather than in a single lump sum based on the Roth IRA contribution level. So those are some changes that are coming or have come already. So again, I welcome any questions that you have regarding anything about the financial markets or the Secure Act 2.0. You can enter those in through the Q&A function. And also, if not, you can send us an email at hello@hiwealth.com, or certainly go to our website and click on a complimentary, easy way to schedule a 15-minute conversation. So thank you for your time. Again, we'll look forward to seeing you at our next event, and enjoy the rest of your day. We greatly appreciate you spending time with us. At Hammond, Iles Wealth Advisors, we're here to create a clear path to purposeful living. We want to be that GPS system for you because of the uncertainty in the future, to be able to redirect you as circumstances change, to make sure that we can continue to move towards your purpose and your goals. Thanks again for joining us, and we'll see you again soon.